I think a lot of people are looking at earnings now where they're coming in. Everybody's still thinking about the Fed. One person said, Powell, don't look at some of the earnings because they're coming in and they're pretty good, right? So what are you thinking?
They're coming in better than expected, but they're still year over year coming in at a lower rate.
Right.
And those expectations are really important because we have to remember where we are in the market cycle. Right now, there's a lot of good news and high expectations as it really relates to earnings already priced into the market. And we're seeing that when stocks are coming out to announce, there's not a systematic return profile. It's actually very asymmetric right now. So in other words, companies that are beating on both the top and bottom line are actually only outperforming the market by about 2%. But
right.
Companies that are missing estimates on those top and bottom lines are actually underperforming the market by over 6%. So there's a lot more negative downside if a company misses.
I agree with that. I see what you're saying. The sell-off happens. People get spooked. Oh, they missed, and I'm selling off, and they go a little crazy on the downside. The point to the upside, when the companies do beat, I think one thing that I was discussing this morning was that it used to be buy on the rumor, sell on the news. What's nice is they're not selling on the news. So a company beats or gives some decent guidance. They're not selling on the news. At least 2% to the upside or something flat to the upside. That might be taken as good news.
That's true, and we haven't seen that reversion where investors are trying to move out of those good stocks. And I think a large part of that is because of the Fed and the upcoming announcement.
Right.
People realize that Powell is going to be coming in here and potentially with a 25 basis point interest rate cut and potentially another 25 basis point cut in the fall. The market is getting very excited about potential easing.
When we talk about easing, investing in this environment, and you're talking about the Fed, and I look at the yields, and you said when you're investing, avoid yield traps. What do you mean by that?
So for the last year or so, we've been in an environment of continuing rising rates where actually fixed income yield actually looks pretty appealing. People are actually getting more in their savings accounts and things like that. It actually looks like a pretty compelling alternative. But we're now starting to approach a decreasing interest rate environment. If the Fed starts cutting, that means the cycle is going to change. When interest rates go down, that means investors move elsewhere to find yield. And equity income often ends up being a really attractive spot. So when I said avoid the yield traps, investors sometimes have the urge of just chasing on companies with really attractive dividend yields. But they ignore the potential fundamentals, earnings profile, expected growth, and valuations. And those are the types of yield traps, while looking really attractive, investors should try to avoid.
So if something has a great 6% yield, you say, oh, wow, great, I'll take it. But you should do some more investigating into the company itself. You talked about slowing growth for this current economy. I think there's people who would agree with that, right? But when you're investing, you like different areas, right? You say be a little more defensive, and the cyclical sectors are overdone. So what do you mean? Could you be a little more specific for us?
Sure. So this is a good economy. The economy is still growing. We're supported by the Fed right now, but we're also 121 months into this expansion. It's the longest on record.
Right.
So,
and it's been a great one.
It's been a great rally, right? But the idea here, the market's up over 300% over the last 10 years. But the bottom line is investors are now way overexposed to more cyclical sectors. Those have done by far the best over the last decade. The S&P 500 is now 75% cyclical sectors.
Right.
Now, in the late cycle, though, there's going to be more volatility. We're starting to see it. Potential misses around earnings announcements could have an outsized impact to the market. So more defensive companies, things like utilities, consumer staples, healthcare, these sectors are less sensitive to the business cycle.
So those are what you like right now?
Absolutely.
Right? Would you say consumer staples?
Consumer staples, healthcare,
and utilities. So the other thing I noticed that you liked when I was going through your notes were global champions, you called them. What kind of companies in particular do you think of, stocks, do you think of when you say global champions?
Sure. So we're thinking about these big multinational type companies that are not just getting their opportunities from the US, but across the board around global markets. And part of this can be supported by also what we're seeing in the currency market right now. Mm-hmm. We have seen the dollar starting to come under pressure, which has really been creating an opportunity and making U.S. assets more appealing for foreign buyers of opportunity. Some of these multinationals are actually the most likely people to come in and support.
Now, when you say to the global champions are the ones you like, should they be within those sectors? I mean, that we mentioned prior?
Yes, exactly. So we think that you need to have more of these resilient, defensive-oriented companies that get more of their return from yield. So in other words, they're providing good levels of income, so they're not growing as fast as some of these more cyclical companies, but they're going to hold up much better in market turbulence. We saw that in May. Right, the market drew down, and some more of the cyclical sectors like information technology drew down by 8% in the month of May alone. These sectors actually held up really well during that environment.
Okay, I just want quick answers. So if the Fed cuts the market, what?
So if the Fed cuts, it's going to be right in line with expectations. So we don't think you're going to see an outsized market impact.
Okay, and if the Fed doesn't cut?
You're going to see a very abrupt sell-off, because the market is completely pricing in a cut right now.
And then the trade deal, no deal with China, how does the market react to that?
It's going to be kick the can down the road. And the market's going to have the same type of impact they've been having, where it's already mostly priced in, which is a no deal or a lukewarm deal. The market's not pricing in a real agreement.